surely reflects and capture the power of patience. So Vishal Khandelwal is there. Let's connect with him, founder of Safal Niveshak. It's a financial portal which needs no introduction whatsoever. I'm a very proud tribe member of Vishal. I subscribe to all his publications, even though sometimes they are paid. I must admit that I enjoy reading the paid subscriptions also. Vishal, so nice to have you back. Thank you for joining us. We are celebrating Teachers' Day, and I must share with our viewers that you've taken the duty of sharing your knowledge as a teacher, not only to your subscribers, but also at Flames University.
Hi, Nikunj. Thank you. You're talking after a long, long time, and I hope you're doing well. I think I have taken this role of being a teacher pretty much seriously over the past 10, 11 years. I have been doing this kind of a work, and it has been fun. Yeah, interacting with people, trying to teach them how not to lose their hard-earned money in the stock market. So there are a lot of people there are a lot of resources where we can learn how to earn money or how to make money from stock markets. But yeah, my job is more towards the behavior side. How do you behave well so that you avoid losing a lot of your hard-earned money over the long term?
One most important aspect, Vishal, which we've discussed openly, publicly, and even privately with you is that when you are approaching stock market, you need to define what your purpose of approaching stock market is, which is like what Buffett says, know what you are. Otherwise, stock market is a very difficult place to learn. Is that the biggest thing anybody should know when you are making a decision to buy, sell, or trade?
No, of course, yes. Knowing yourself, I think you mentioned a very nice quote that if you don't know what you are, the stock market is a very expensive place to find that out, right? So that self-awareness and the purpose for which you are investing in the stock market is such an important question that everyone should ask. And the kind of person that you are, you should be very careful of what kind of person you are, right? Self-awareness is necessary. We all talk about understanding financial statements or reading annual reports and finding companies and betting on sectors and industries, right? But the starting point of it all is like, do you have the capability, the patience, the humility, the rationality to actually invest and benefit from whatever growth story that you are betting on, right? So if you are listening to people now, we are very gung ho on how Indian economy is going to grow for the next 10, 15, 20 years, like the India century, right? The question is, do we have the legs to actually participate in this journey for a long period of time rather than just buying and selling on a daily basis? So knowing yourself, very important. I think that's one of the most important things that you can do as an investor when you're starting out or any time in your investing career.
The other important aspect, Vishal, is to understand the importance of durability. Buffett uses the word moat. Some would like to use as competitive advantage. These are the words which describe a good business or differentiates a good business from a bad business. But in today's digital world, well, cycles are short, world is disruptive, the life cycle of a company is narrowing. How does one go about following a simple strategy of buy and hold? And I'm using this reference for the benefit of our viewers, Vishal. When COVID happened, IT made a comeback. Now suddenly IT is on a back burner, banks are making a comeback. How does one go about figuring out the importance of long-term investing when cycles themselves are getting short and disruptive world is what we are living in?
Well, I think life moves in cycles as well, like, which we all know, right? We all have our ups and downs. So we don't really turn around our face from life and say, oh, I don't want to live it, right? That's the point about investing as well. Investing will have its cycles, sectors will have their cycles, companies will have their cycles. The idea, as I mentioned, right, is to know whether you have the capability and the patience and the humility to be a part of those cycles for a long period of time. Once you have identified a good quality business, like you talked about Mr. Rakesh Jhunwala with a previous, I think just a short time back, and how he held on to Titan for so many years. And I've known so many people who held on to high quality businesses for 10, 15, 20 years. The changes are not new, right? The cycles are not new, as you rightly mentioned. It's just the cycles have shortened, right? So in that sense, someone who has a long-term holding period itself has a competitive advantage just because the cycles have shortened. Investors' attention span has shortened, right? You can create a differentiation for yourself and do better than the average investor by just focusing on the long term, staying through the cycles, be willing to stay through the ups and downs of the markets, right? And just holding on uh, with a disclaimer that buy and hold does not mean buy and forget, right? You have to keep reviewing your ownership in companies. You have to keep reviewing businesses, not on a quarterly basis, never on a quarterly basis, in fact, maybe once a year. If things are fine, you just keep owning them, right? There's a dearth of high quality businesses, high quality managers in India. and globally as well. So if you manage to find someone, right, with whom you want to partner for the next 10, 15 years, right, you have to run through them for the next 10, 15 years rather than saying, okay, the world is getting disrupted, right? You are then understanding that the company that you are investing is not going to disrupt, right? It's only going to be at the receiving end, right? So your understanding of the business needs to be so well that you understand that you can participate in that business growth for the next 10, 15, 20 years till the time the business remains good through cycles, across cycles. So yeah.
Vishal, also taking a leaf from what Buffett said, that the secret of happiness is having low expectations. Easier said than done because, as human behavior, you very rarely disconnect between what you can control and what you can't. And somewhere behind every move of ours, there is hope of a return. There is always that expectation which leads you to do something that you want to do or do. So just wanted to understand, because I was just going through some of your notes, and you said that what you really need to disconnect from is what you can't control, and that boils down to returns. Now, as a stock market investor, across the board, I mean, be it trading or investing, you come to stock markets to get those returns. So it's very difficult to disconnect that. Just wanted you to, delve a little deeper into this.
No, I think that's a nice question. The point is that, you see, the reason we are focusing largely on returns, something that we don't control as far as stock investing is concerned, because we are seeing the numbers on a daily basis. We are seeing stock price charts moving on a second by second basis, right? We make a lot of investments in life, whether they're investments in children, whether they're investments in a property, or whether they're investments in ourselves and investments in stock markets. The only thing that we track on a daily basis is stock price returns, and we don't track our children's growth and improvements on a daily basis. Neither do we track our property prices. Neither do we track ourselves, right? It's very important to grow gradually over a long period of time. Put that sound investment in yourself, your family, and everything. As far as stock market is concerned, I think people need to disassociate themselves with, as you mentioned, what you can control and what you cannot control. You can control the risks that you take. You can control the costs that you incur as far as investing is concerned. You can control to some extent your behavior. Yeah, and you also have some control on the time that you have as far as investing is concerned. The only thing that you don't control is return, right? And over the long period of time, again, if I were to pick out a leaf from Ben Graham's book, who was the teacher of Warren Buffett, he said that in the short term, the market is like a voting machine. We all are emotional and we vote through our emotions. But in the long run, the markets are like weighing machines, right? So the weight of companies are justified. A high quality business is going to return a high quality numbers or high quality growth over a long period of time. A bad quality business is going to destroy your capital. So returns are going to come if you follow the process, if you have the patience of sticking to your process for a long period of time. So you don't control return, but you can always expect good quality returns or adequate returns over a long period of time only if you are patient enough to achieve that.
Vishal, the other thing which is currently happening in the market is some of these penny stocks are the ones which are really up and roaring. And, there's a long list of them. In just the last 10 days, they've made returns of 25% to 60 odd percent. Often retail investors do get trapped with small ticket stocks. I just want you to, delve a little bit into how should one avoid large losses and, investing in penny stocks is a clear-cut way of ending into the deep end.
Well, yeah, it certainly is, right? I have been talking to investors for the past 20 years, interacting with them, and I see very interestingly that a lot of people want to buy stocks which are priced low or which are priced in single digits or double digits, which is largely what penny stocks are all about, right? The price of the stock does not matter. What matters is price versus the fundamentals of the business, right? So what really matters for an investor and how one can really ensure that he or she does not lose his shirt or lose capital permanently in penny stocks or any kind of business is to understand the kind of business that you're getting in, understand the kind of management you're getting in. It's hard work, and that's the reason I think Buffett says investing is simple but not easy. We know the simple rules of investing, but following through those rules, understanding businesses, understanding valuations, right, understanding yourself is what is not easy, right? So I think that's a simple way of, as I mentioned, right, you can simply create a differentiation between yourself and the average investor by just having that patience and thinking long term and doing your work. Of course, as I said, you cannot really survive on tips from someone, right? Because you can get a tip, but you cannot get conviction of owning that business for a long period of time, right? So I think it's easy to avoid losing capital permanently. Of course, you cannot expect to have a 100% track record. I was reading Prashant Jain's recent parting note from HDFC, which he called SAR, which is Essence, and he mentioned in that note that over his 30-year investment experience, he still had around 26% of his portfolio stocks which lost him money, right? And there was 1% of the portfolio stocks which lost him big amount of money, but the remaining 74% of stocks actually made him money, right? So the essence of that thing is that even when someone like Prashant Jain can have a 74% track record of stocks which earned him money, the important thing to note is there's just 1% stock that lost him money big time, right? So cutting your losers, avoiding capital destruction should be the primary focus of investors. And as you mentioned, penny stocks is a hotbed of that thing. So I would request investors to be very careful of investing in penny stocks. Rather, they should avoid doing that.
Okay, now the most important aspect, Vishal, and I'm going to again use a reference for the benefit of our viewers, the stock price of iShares. What we've done, Vishal, is that we've looked at the 20-year chart of iShares. And it's only when you look at the data, you realize how the stock has moved. So iShares has been one of, again like Titan, an absolute stellar multi-bagger. But the journey of iShares, if I compress it in a 20-year chart, the first 10 years iShares gave you flat to no returns. Yep. Similarly, in the time period of 2008 versus 2018, iShares became one of the biggest multi-bagger. Now Vishal, no one knows what the 10 years of flat return are and the 10 years of exponential returns are. How does one go about keeping patience? How does one go about just keeping it calm? Like you say in one of your newsletters, zoom out, baby, zoom out.
Yeah, that's one thing. Zooming out and looking at the pictures, looking at things from a broader perspective is important. But I think it's a very important point that you raised, Nikunj. Patience is one thing. That patience needs to be backed by process, right? If someone really understands iShares, or let me give you an example which is even longer. Look at Microsoft, because that's a company which I was studying recently as far as long-term performance is concerned. Microsoft came out with an IPO in 1986, and by 1997, 11 years, the stock was already a 100 bagger because it was the biggest company in the world, almost, right? Selling the most computers in the world and had that MS-DOS that we all used to use during that period of time. So 100 baggers in 11 years. 1999, at the peak of .com, right? It touched around $58 per share. For the next 17 years, the stock did not go anywhere. Right, so people who held on to that stock for 17 years, of course, I'm sure there were not many people who bought at the peak of the .com crisis and held on for 17 years, had earned 0% return, right? So, but the people who actually bought in 1997, which is before crisis, and held on till 2022, earned a 16-17% CAGR, which is a good enough return, plus the dividends from a company like Microsoft that you've earned, right? So if you had a process of understanding that Microsoft, which was a high quality business or a super high quality business in 1986 to 1997 till 1999, actually suffered against a lot of other companies because the business was not doing so well. The management was not taking proactive steps to get into, say, smartphones and mobility devices and everything. So Microsoft lagged behind, right? And that's the reason for 17 years actually did not do anything. And after 2016, it just skyrocketed because we now have Teams and we now have Microsoft Office subscription and so many good things that the company has done for the last 5, 6, 7 years, right? So in the same way with iShares or Titan, right, you can have the patience of owning these kind of businesses or deciding that, okay, this is not the time, probably the next 5, 10 years is something that I don't want to own these kind of businesses. Only when you have a sound process of knowing what the kind of business is all about, what are the reasons for owning that kind of business, right? Return, as I mentioned, return is not in our control, right? So there's something called as process, right? So process versus outcome is a very important thing that every investor need to look at. The process is in our control. The outcome is not in our control. So if you know the process, right, you would be able to decide whether you want to stay invested in a business which was supposedly high quality, right? Even now as well, right? So as I said, buy and hold does not mean buy and forget. Right, you have to keep asking questions whether iShares is a good quality business for the next 10 years. If no, the brand name does not really matter. You have an opportunity cost. You can use that money to buy something else, which is even better high quality. Right. So even with a high quality business, we should not be looking at them with rose tinted glasses. We should have a sound process and only then decide whether you want to stay invested or invest in the businesses that everyone wants to invest in. So process is the most important underlying thing to patience.
Okay. I'm going to put another chart out, Vishal, a company which you've written about in your newsletters as late as I think 10 days ago, Asian Paints. Great business, super franchise, management needs no introduction whatsoever, dominant market share. Now, Vishal, when a company like Asian Paints, when you encounter it, the biggest criticism is good company, but it's a bad price. It is like saying that you are buying gold at the price of diamond. In investing, if you buy gold at the price of diamond, you will not make money. In investing, you have to buy gold at the price of silver. But some of these companies never come at the price of silver, yet they create wealth, yet they've been compounders.
They will not be coming at the price of silver because of demand and supply, given the inflow of new investors and intelligent and educated investors over the past many years, right? Information is not scarce anymore. Everyone has the same kind of information. Everyone knows the same kind of companies. Everyone buys the same kind of companies. So you will not expect the prices or valuations of these kind of business like Asian Paints or those businesses, right, to actually come really down, right? But the point is that someone who is looking to buy such kind of businesses, or not just Asian Paints, or even high quality businesses like Asian Paints, right, needs to wait for that appropriate price. Now, appropriate price, if I were to just give a multiple, like a price to earning that people do can understand, right, you will not get Asian Paints like 25, 30 times price to earning. But from a 70, 80, 100 times price to earning, there are opportunities every now and then. We've seen Titan correcting by 50%. We've seen Asian Paints correcting by 30, 40, 50% as recently as COVID, right? You will get opportunities to buy these kind of businesses maybe 40, 50 times price to earning if you are just looking at that number, right? But if you, as I mentioned, if you have a long-term time horizon, right, you can still pay up. I'm not saying overpay. You can still pay up for high quality businesses and keep owning those kind of businesses till they remain good, right? So it's only when the stocks are expensive that we think that we are not going to get those stocks again. The problem is when those stocks actually correct and come down to a reasonable price, we think that, okay, I'll wait for another 10% or 20% correction and probably the world is going to end, right? So I would probably wait if I survive for the next 30 days and then I'm going to buy Asian Paints. Now, that is a small window of opportunity that we get from time to time. We need to benefit from them. And that benefit is only going to come when we know that Asian Paints is, for example, is a good quality business that needs to go at a given price, right? So opportunities come, market cycles have become very volatile, but they have also shortened, right? But over a long period of time, I think growth in a business, the return on capital in a business wipes out somewhat of the sins of paying up for quality. So you can pay up, right, somewhat, but if the company continues to grow, I think that sin of paying up is going to get wiped out. Right? So you should not be worried about paying too lower prices. You can pay up for high quality businesses, I think, in today's world.
Okay, Vishal Khandelwal, we're going to leave it right there. Thank you so much. Today's, of course, Teachers' Day, so we thought who better than you to have on the channel today to